In this video, we're going to be talking about the Fisher effect and the costs of inflation. So recall that we talked about money being neutral in the long run. Money is neutral in the long run, which is to say that money does not impact real variables in the long run. Okay, now we also know that the real interest rate from the previous chapter, we know that the real interest rate is just the nominal interest rate corrected for inflation. So you subtract off inflation from the nominal interest rate and you get the real interest rate. Now, in order for this not to change, in order for the left-hand side not to change, anytime the Federal Reserve increases the nominal interest rate, inflation would also have to increase, and it would adjust one for one. So usually the Fisher effect is saying that the Fisher effect actually says that the nominal interest rate adjusts one for one with expected inflation. And even if we plot nominal interest rates and inflation, we would see that they move together. And the difference between that is the real interest rate. Of course, in the short run, there are differences, but in the long run, there is a one-for-one movement. Okay, that takes us to the costs of inflation. Now, the first cost of inflation but before we talk about the cost of inflation, we want to think about that a lot of times people argue that inflation is a serious economic problem because when prices rise, their incomes can't buy as many goods and services. So they believe that inflation is somehow directly lowering their standard of living. Now, this argument has an issue. Since people earn incomes by selling services such as labor, inflation in nominal incomes also goes hand in hand with prices. So if you live in San Francisco, for example, then if prices of goods and services are rising, your incomes, you would also be offered a higher wage. So there's also wage inflation that's going on simultaneously. So inflation by itself is not affecting the real purchasing power of people, but it is, you want to look at what's going on with the wages, with incomes, with earnings, and then look at what's going on with the overall level of prices and see the difference between that. But there are some of the more subtle costs of inflation. The first cost of inflation we will talk about is called the shoe leather cost. So we know that inflation is a tax on people who hold money. Now, to avoid the tax, people can hold less money in their pockets and keep more money invested in interest-bearing accounts. So you have an option to keep money, cash in your wallet versus cash at the bank, right? So whenever there's inflation, you prefer to keep cash at the bank because you would earn some interest on those deposits. So interest earning deposits, okay? If you just keep it in your wallet, you're not earning any return on that money. So as a result, people would have to go to the bank and withdraw more money than they would if there was... So think about a scenario where you need to go to the bank to withdraw cash because now prices are rising. You need more money. So you would make more trips to the bank, right? You would go to the bank, withdraw it. And so these costs of you going to the bank very often, this is figurative speech, but they are known as shoe leather costs, since your shoes would be worn out from all those trips to the bank. Okay, the actual cost of holding less cash is really just wasted time and inconvenience. And so at high rates of inflation, the cost is a lot more. Okay, if the inflation rate is not so high, then this is not a problem. So this is really just about more trips to the bank and this causes wasted time and inconvenience. Okay, now menu costs. So there are numerous costs that are associated with changing prices. Now, if you think about it, if prices are changing in the economy, like let's say the price of oil has gone up, then the prices of everything, all the goods and services get affected. Now, there are costs of printing new menus. If you were running a restaurant, you would be affected by that. New catalogs, price lists, mailing costs, because typically you would, as a business, you would distribute your catalog. So mailing costs for of distribution, advertising costs, because now if prices have changed and you're adjusting your your prices, then you need to advertise these, and just costs of deciding new prices. So again, in figurative speech, these are called menu costs because this is the price that's associated with changing prices in a catalog. So this was the second cost of inflation. The third cost of inflation is that there is relative price variability and usually misallocation of resources that goes with that. Now, we know that it's costly. It's costly to change prices. Okay, and firms try to change prices as rarely as possible because of this cost. Okay, so this is firms try to rarely change prices for this reason. Unless you had like an electronic catalog and that's all you had, where you could quickly change prices without incurring a cost. But whenever there's inflation, the relative prices of goods whose price is held constant for a period of time is falling with respect to the average price level. Okay, so this is to say that if you were selling jeans, for example, then if you look at the price of jeans relative to the overall price level, this is what matters. Okay, so you would end up misallocating resources because economic decisions are based on relative prices. How many jeans you're going to sell at that price is going to depend also on the overall level of prices. So you might be considered as a seller about this ratio of price of jeans to the overall level of prices. So a good whose price is changed only once per year is artificially expensive at the beginning of the year and artificially inexpensive by the end of the year. Okay. Now, the fourth cost of inflation is that there are some tax distortions that are induced by inflation. Inflation typically raises the tax burden on income earned from saving, and thus it discourages saving and growth. Okay, there are two types of taxes on savings that we will talk about. So one type of tax is called capital gains, and the other type is we'll discuss that, but let's think about capital gains for a second. So capital gains are subject to taxation. These are things like if you owned a stock for $30 today, and tomorrow you sold it for $50, you would be making a profit, right? That profit is called your capital gains. And so what matters is not just that you made $20 when you sold the stock, but what also matters is what went on with prices between, what is going on with prices between today and tomorrow. Okay. And so the tax code itself doesn't account for, the tax code does not account for inflation, right? So the real gain that you would have is going to be less than $20 if prices were rising between today and tomorrow. Now, the second type of tax distortion occurs when nominal interest is taxed. Okay, so whenever the government takes a fixed percent of nominal interest rate as taxes, the after-tax real return grows smaller as inflation increases. Okay, so the idea is that whenever you have interest income, if you're putting money in a bank and you are, the bank gives you, let's say, 6% on your savings per year, the government is going to tax the nominal interest rate. This is the nominal interest rate, and the government tries to tax that. But inflation could be, again, a problem because inflation could be rising between one year to the next, and so your real interest rate might actually be lower. Might be lower if inflation is positive. So you have this problem again where the tax code doesn't account for inflation, and so your after-tax real return falls. And we'll take an example and look at how this works. We'll take a look at that. But we can also talk about a fourth type of, so this was inflation-induced tax distortions. We can also talk about fourth type of cost, which is related to confusion and inconvenience. And again, inflation causes that. So money, serves as a unit of account, which means that the dollar is the yardstick by which we measure economic variables. So whenever the Fed is increasing money supply, whenever there's more money in the system, it's going to cause prices to rise. And that decreases the value of money, which is 1 over P, right? And it shrinks the size of the measuring stick that you have, okay? Which makes accounting, if you're trying to account or budget, accounting for firms' profits and balance sheets becomes difficult. In general, if you are a consumer or a producer, if you can't understand the yardstick, if it's changing constantly, it makes daily transactions and budgeting. So daily transactions and budgeting is confusing. Okay, now the last type of cost of inflation is different, because this is usually caused when there is unexpected inflation. Okay, anything that we've described previously exists if inflation is stable and predictable, but inflation has this additional cost to the economy if it is unexpected, because it arbitrarily redistributes wealth. Okay, that's why the cost itself is called arbitrary redistribution of wealth. So if you think about it, usually when a person A is taking out a loan from a bank, so let's say this is the bank, and person A is taking out, this is a bank making a loan, so dollars are flowing this way, and there's a contract that specifies, the interest rate, the principal, etc. Those are the terms of the loan, right? So these terms of the loan, are generally expressed in nominal values based on a certain certain amount of expected inflation in the future. So the bank might say, well, if the bank expects inflation to be 2% next year, they might say, well, we're going to charge you an interest rate of 4%. Okay. And so if inflation is higher than expected, right? So this is what they are expecting. Okay. This is expected inflation is 2%. So they made this contract today expecting inflation to be 2% tomorrow. Okay, but now if tomorrow comes and actual inflation, actual inflation is 5%, then the real interest rate is lower for the bank, right? They're not making as much. So if inflation is higher than expected, borrowers, like this guy here, is a winner. And lenders lose. Okay, this is to say that borrowers would gain at the expense of lenders, and there will be a redistribution of wealth from the bank, who's the lender, to the borrower. Okay, so this happens when inflation is higher than expected, and you can think about a scenario when inflation is lower than expected. The redistribution would be from borrowers to lenders. Okay, so borrowers would lose and lenders would win. Now there is this idea that deflation is bad. Okay, now Milton Friedman argued that small and predictable deflation, which is equal to the real interest rate, could be desirable because it would drive nominal interest rates near zero, and that would reduce shoe leather costs. But costs of deflation can mirror other costs of inflation. So deflation is usually a sign of broader economic problems. When prices are falling, this is not very good news for sellers, because they would not want to produce as much. Okay, and so what you want is a little bit of inflation. Is good for the economy. And it keeps labor markets healthy.